Let's get across more of today's trade. Chris Conway from the Australian Stock Report is joining us live from our Melbourne studio. Chris, good afternoon to you, and thank you so much for joining us. Now, a bit of a weaker open there this morning. We're following obviously what we saw on Wall Street overnight, but it's all down to those oil prices, energy stocks and materials really taking a slump today.
Good afternoon, Leanne. Yes, look, I couldn't agree with you more, if not for the fact that oil prices were off 5% overnight, and we have BHP and South 32 trading X in the material space. Those two sectors would be performing better and the market would be in positive territory. So in light of the negative leads that we saw from Wall Street overnight, I think a reasonable performance for the Aussie market so far today.
Now, talk us through it. We're going to, if we can, just bring up a technical chart that you've provided for us. And you're talking about this wedge pattern that seems to be forming on the ASX 200. We've got it right up on the screen right now. So just talk us through what you're watching from a technical point of view.
Yeah, so look, obviously we had some highs recently above the 5,800 mark, I think up around 5,830. And prior to that there was a swing low, and on the chart there should be drawn a couple of orange lines, and they obviously move out to the right and form a triangle pattern. You know, it's really indicative of the fact that the Aussie market has sort of been grinding sideways lately. Neither the bulls nor the bears can seem to gain the upper hand. And, you know, the textbooks would have you believe that when these sorts of patterns form, they precede usually large moves. And again, the theory would have you believe that the market will move in the direction that it came from. So, of course, we had been rising prior to the formation of this pattern. The theory would have you believe that we're going to break higher, and that supports my view that we get to 6,000 sooner rather than later. So just an interesting pattern. Like I said, it's indicative of the fact that, as I said, the market really is grinding sideways at the moment. There's no party that's in more control than the other, hence why we've been grinding sideways. But we hold our breath for a big move that's potentially on the way, probably around when the US raises interest rates, or the Fed raises rates, I should say.
Yeah, that was actually going to be my next question. If this theory proves correct and your target of 6,000 is in play, what will actually get us there?
Yeah, so really good question. Obviously it follows on nicely from what I was just talking about. It has to be that once the Fed raises, that US markets push higher once again, and the Aussie market follows suit. So I had been calling for 6,000 towards the end of the March quarter. We're getting right down to it. We're getting right down to the point where, you know, markets sort of need to start moving. The reason why I think it can happen after the Fed raises rates, all right, we know that that's pretty much priced in. I think it's a 90% probability at the moment. Quite amazing that it was only a matter of weeks ago that that probability was 25%. Goes to show you just how quickly markets can change their opinion and figure out what they need to figure out. But if we look back over the course of the past 12 months, every time there's been a big macro event, markets have sort of traded sideways into the event. Sometimes there's been a sell-off. You know, I'm thinking Brexit, I'm thinking Trump. There's been big sell-offs on the day. But generally after the event, markets have risen. So we're hoping that I'm hoping that pattern repeats itself. Once the Fed drops that they are going to raise by 25 basis points, great, everyone knows it. They plug it into their models. And as I've said before millions of times, Wall Street will get on with what it's good at doing, and that's making money. And hopefully the local bulls follow suit.
Let's talk more about crude prices, obviously a drag there today, and look, a lot of noises suggesting potentially we could be in for lower crude prices. I think overnight we saw the biggest percentage loss since February 2016, so quite a big loss overnight, but there seems to be this battle. We're in sort of uncharted waters right now between the US shale industry and OPEC.
Yeah, look, those two parties are really searching for the right price. Obviously, shale producers want to see prices go higher so they can bring production back online. But of course, in doing that, that means that there's more supply, and that will in fact put downward pressure on prices. You know, where that equilibrium sits within that market alone is interesting. And then, of course, you balance it against the fact that you do have OPEC and indeed Saudi Arabia saying that they'll do just about whatever it takes to support prices. And of course, the Saudi keen interest in keeping oil high. That's because they have a fairly generous social welfare system that is underfunded at the moment. It needs to be funded by the sale of oil. So they have a very, very strong interest in making sure that prices remain elevated, and they have been on record as saying that they will do just about whatever it takes to keep prices elevated. So look, I must admit, Leanne, that some of the reaction to the sell-off that we saw last night is I don't think it's warranted. You know, if you look back at at oil prices over the course of the last couple of months. They've been hovering essentially between about $51.50 and $55. If you go back a little bit further, it's really between $50 and $55. So oil pulled back $2, maybe 20 overnight, down towards 50.70 or 50.80. I think it's still essentially in the range. Yes, it was a big move, but knowing that there's some support under those prices for the reasons that I've just outlined, and the fact that we're still trading within the range, I'm not sure what the reaction is all about this morning. And I really think that's reflected in the fact that Aussie oil plays like Woodside and Santos aren't as down as much as maybe what some people would have anticipated off the back of a 5% fall in oil prices. I think the market knows that there's support there.
All right, fantastic. Let's move on to a couple of others that you're watching. You mentioned some of those that are going ex-dividend today. QBE is one of those. It's off 1.9% right now, $12.63. We know that this one has that exposure to US interest rates. Are you a holder of this? Do you like the outlook for QBE?
Yeah, we absolutely are holding this at the moment. It was nice to see, or at least it was on the way to the studio. It was holding, or it wasn't down by as much as its dividend from this morning. So the dividend was 30 cents. I think when I left the studio, it was down 25 cents. Obviously, a bit of a stronger shift. Yeah, still a bit of a stronger shift even overnight on the back of the ADP employment numbers. You know, again, firming up the chances that the Fed will raise next week. Of course, we have non-farms on Friday night. If they come out anywhere near expectations or beat, which is looking more likely now on the back of the ADP last night, then that again should firm the likelihood that the Fed will raise, but in March. But it also means that possibly the pace of interest rate rises over the coming 12 months is going to hasten. So instead of maybe being 2, there'll be 3, or I think there's even maybe conversation now about there potentially being 4. You know, that's sort of re-entered the conversation. So in that vein, the fact that QBE would stand to benefit from US interest rate rises, of course, they've got a lot of bonds in their investment portfolio. Rising interest rates means rising yields, which means better returns. That's why we like QBE, is because of that exposure. So yes, we are holding it at the moment, and it's really that play on US interest rates that is the reason why we're in there.
Speaking of another play on US interest rates, we often talk about the major banks, particularly in the US, that will benefit from rate rises over there. What is the implications for our local banks? We've just come out, of course, of the banking inquiry, so we've been talking a lot about the banks recently, but CBA, I know, is one in particular that you think looks technically strong. What's your view on the banks and CBA in particular?
Yeah, look, we do like CBA. To me, it's still best of breed, and the reason why we're holding it is partly because it's a macro or an index play, if you will, in the sense that I believe the Aussie market is heading higher, and if the Aussie market is to head higher, well, banks and CBA in particular have to participate. It's almost guaranteed that if the Aussie market goes higher, then the banks will as well. Hence why we're holding it. As for the rising interest rate story in the US and whether or not it will benefit local banks, I think the jury is still out on that one. There are some opposing arguments. One side of it is that rising interest rates in the US will mean you'll see fund inflows into financials in the US and probably financials around the world. And of course, Australian financials are pretty strong on the global stage, so they'll see some upside benefit there. Fundamentally, though, you know, it shouldn't really change the local story in the sense that, okay, funding costs will go up. Margins, those funding costs will be passed on to consumers, i.e. mortgagees. And the net interest margins shouldn't change. I also don't think maybe now there's, especially after the banking inquiry, the possibility that the banks will carve out a little bit of extra cheese for themselves, in the sense that, you know, they'll say that their funding costs are going up and they might add a couple of basis points for themselves. I don't think the political environment will allow them to do that. So, like I said, opposing sides of the coin. For us, really, though, holding CBA, it's more of an index play.
All right, fantastic. Chris, appreciate your time as always. It's been great chatting to you. Thanks for joining us.
Thanks, Leanne. Cheers.
Chris Conway joining us there from the Australian Stock Report. Let's move